The NYSE FANG Plus Index Fund of Fund and ETF by Mirae Asset allows Indian investors the opportunity to invest in the fabled FANG Plus stocks of the American stock markets. FANG Plus is an acronym for companies like Facebook, Apple, Netflix, and Google, and the FANG Plus Index includes a bunch of other high growth companies apart from the names that I've just mentioned. The FANG Plus Index was created in 2017, and whatever returns that you see between 2014 to 2017 are simply backtested retrospective data. The NFO will be open between 19th April and 3rd of May 2021 at an initial price of 10 rupees per unit. During the NFO period, you can invest in a minimum of rupees 5,000 per investment, and subsequent to the NFO, you can invest as little as rupees 1,000 per investment. You can also start an SIP in this fund. If you have a demat account, you can invest via the ETF route. But if you do not have a demat account, or you do not want to keep these investments in your demat account, you can invest via the fund of fund route. The fund of fund by Mirae Asset will make the investment in the ETF on your behalf, and you wouldn't need a demat account to hold this investment. The FANG Plus Index consists of 10 equally weighted technology stocks: Facebook, Apple, Amazon, Netflix, Alphabet, or Google, which make up the initial, FANG hype that was there in the market. And then this index also has high growth companies like Alibaba, Baidu, Nvidia, Tesla, and Twitter. These names are some of the biggest emerging names in the global economy today, and the coronavirus situation has in fact boosted the business prospects for these companies. The current weightage to each stock is as given on the screen. The index is rebalanced to equal weightage on fixed tenures. Talking about the opportunity, the market capitalization of these 10 companies is around $7.7 trillion. This is nearly 3x of the entire Indian market. The revenues of these 10 companies put together are $1.09 trillion. This is nearly 3x of the entire Indian government's receipts. We are talking of 10 companies that put together are almost 2.5x of the entire Indian GDP. And you can witness the growth of these companies simply on the basis of products and services you have been using over the last 3 to 4 years. The FANG Plus Index has delivered 46.8% CAGR over the last 5 years. This means that every rupee invested in this index would have grown 7x in 5 years. The Nasdaq Index has delivered 28.1% per annum in this period, while the Nifty 50 has delivered 17.3% per annum during this period. The FANG Plus Index trades at a PE ratio of 55. A price to book ratio of 7.88 and price to sales ratio of 8.3. The ETF is expected to have an expense ratio of 0.33%, while the fund of fund is expected to have an expense ratio of 0.5% under the direct route. On the taxation front, investors should note that the international funds are taxed as debt funds. This means that if you book profits before 3 years, the tax rate will be as per your applicable tax rate. If you book profits after 3 years, the tax rate would be at 20% flat with indexation benefits. The cost structure doesn't look expensive, especially considering how expensive it is for Indian investors to otherwise get access to the American markets. Let's talk about the risks now. The index is already up 7x in the last 5 years. This means that it isn't really undiscovered or beaten down cheap. The companies that form part of the FANG Plus Index are growth stocks and are richly valued on the assumption of a sustained high period of growth rate. The American markets are flush with pumping of money from the central bank and are at all-time highs on the hopes of a sustained period of economic growth and recovery. The American markets have seen many bubbles in the past, and this could be very well touted as the next bubble by few experts. The FANG Plus Index is nearly as expensive on the valuation metrics as the Russell 1000 Growth Index was at the peak of the dot-com bubble. In the late 1960s, there was a similar chase for growth stocks in America, which had a fat share of corporate profits. However, not everything that goes up is a bubble. Apart from the risk of the index crashing, there is always an element of currency risk when investing in foreign stocks. If the rupee strengthens against the dollar, your realized returns would be lower than the index's returns. On a risk scale, I would categorize it as a very high risk. Now, should you invest? Young investors are in a situation where they are kind of aware of what these companies do, and they are able to appreciate the tremendous growth story and user base backing these companies. And most of these names are today not even in their mature stage now. These 10 companies together own $500 billion of cash and command a profit of $179 billion. They are using this cash for R&D, they are using this cash for acquiring startups and kind of building up their moats for the future. We cannot extrapolate the past returns to the future returns for the FANG Plus index, and an Indian investor investing in this ETF or fund of fund should ideally have a 3 to 5 years horizon at least, and not expect money to double every 1 or 2 years going forward. Over the next 5 years, I believe that this ETF is well placed to deliver mid-teen returns, and it offers a medium to invest in some of the fastest growing names on the planet at an affordable low cost. This investment also allows me international exposure to my portfolio, something which is highly recommended because rupee depreciation is a reality. You can go ahead and check the value of rupee versus dollar over the last 5, 10, 20 years, and the rupee depreciating will only add cherry on top to your returns. However, investors should be cognizant of the allocation and not recklessly put in a large chunk of their portfolio in this investment. You can choose to invest via the ETF or fund of fund as per your comfort level. I would personally wait for the liquidity in the ETF to pick up, otherwise the bid-ask spread would impact my costs. Moreover, demat charges and brokerage should also be considered by ETF investors. On a rupees 1 lakh investment, the FOF or the fund of fund would cost you an additional 170 per year versus the ETF. So you can take a calculated choice as to what your preferred route of the investment would be.